Good morning, ma'am.
Good morning. How are you, Aisha and Rabia? Do we have Mariam with us?
Good morning, ma'am.
Good morning. I think Aisha and Rabia are with us. Mariam is not. Okay, now she has joined. Okay, students, I warmly welcome you to my class. And today we are actually going to step into the financial accounting. Okay? In our previous lecture, we have discussed about financial accounting and the basics of financial accounting we had discussed. Just give me a while.
Good morning, ma'am.
Good morning. How are you, dear?
I'm fine, alhamdulillah, ma'am.
I hope the whiteboard is visible to all of you. Okay, students, we had discussed about the elements of financial accounting in our last lecture. I would like to revise the elements of financial accounting with you. There are 5 elements of financial accounting, namely assets, liabilities, equity, income, and expenses. This is from where the story of financial accounting actually starts, because these 5 elements are going to be encountered by you in your whole subject of financial reporting. Basically, this financial accounting is a narrower term. The actual broader term which we use for financial accounting is financial reporting. Because as I told you earlier, that accounting is an art of recording, classifying, and summarizing the business transactions for the purpose of analysis. The purpose of financial accounting is to produce the record so that the users of the financial statements can get a know-how about a business. We are preparing financial statements. We are into financial reporting because we want to help the users of the financial statements to analyze the business. When we are giving them an opportunity to analyze the business, it means that we are giving them a know-how about the business transactions, that what has occurred during an accounting period, whatever incomes and expenses we have earned or we have incurred during an accounting period, we have to show them. Whatever assets and liabilities are there in an organization during an accounting period, we have to show them. Whatever equity has increased or decreased during an accounting period, we have to show them too. So we have to give them a know-how about 5 things. Whatever has happened in these 5 heads, we have to tell them about these 5 things, namely assets, liabilities, equity, incomes, and expenses. I have told you the definition of assets in my last lecture. What are assets? Assets are any kind of economic resources, or simply the things which are used within a business to increase the resources and economic resources of the business itself. Whatever is being used in the business in order to increase the wealth of a business, in order to increase the economic resources of the business, are known as assets. Whatever is being used, if it is a thing, if it is a right, if it is a contract or an agreement, if it is used for the purpose of earning profit within a business, it is known as an asset policy. Got it? Assets are also known as resources for the business. These are the things which we are using in the business to enhance performance. Now, assets are broadly classified into 2 categories, non-current assets and current assets. Non-current assets are also known as fixed assets. The other name for non-current assets is fixed assets. These are the assets which are used in the business for the period of more than 12 months. Whatever things, whatever rights or contracts are used within a business for more than 12 months for the purpose of earning profit are known as non-current assets. Say, for example, land and buildings. Say, for example, any kind of office. Say, for example, factory, motor vehicles, equipments, machineries. All these are non-current assets. These are the assets which will be used in a business for the period of more than 12 months in order to generate benefits for the business. Even the inventory, the stock, which is held in a business for the purpose of earning profit, because that inventory is going to be sold in an ordinary course of the business to generate profit, that inventory is also known as an asset. But there is a difference. Inventory is a current asset, because by standard IS1, current assets are all those assets which will be used within a business for lesser than 1 year in order to generate economic benefits. So even cash is an asset, but it's a current asset because it will be used within a period of 1 year in order to generate economic benefits. So over the period, we can see so many assets and resources in the business which are helping the business to generate economic benefits. Some of those can be classified as non-current assets and some can be classified as current assets. So by definition, non-current assets are all those assets which are used within a business for the period of more than 12 months. And we do say that non-current assets are normally not purchased for the purpose of resale. We do not purchase non-current assets for the purpose of resale. We can sell them, but not in the ordinary course of the business. We do not sell the non-current assets regularly to earn profit. These are not going to be falling in the ordinary course of the business. On the other hand, current assets are all those assets which will be used within a business for a period of 1 year. Within a year, they are going to be expired. They are going to be taking a new image or a new thing they are going to become. They will be expired within 1 year to generate economic benefits. Say, for example, cash. Cash is an example of the current asset. This is the most liquid asset. It's a liquid. Cash is also known as liquid asset. Why? Because it is already in the form of cash. On the other hand, we have receivables. Those persons who have purchased the things from us on credit basis. They have purchased the things from us on credit basis. They have promised us to pay in the future. So those receivables are also current assets. Then we do have inventory, stock in an ordinary course of the business, which we are storing so that when the time comes, we can sell them in order to generate benefit. So current assets are going to be expired within a period of 1 year, whereas non-current assets are not going to be expired within a year. And the examples of non-current assets are land and buildings, motor vehicles, equipments, furnitures and fixtures, whereas current assets can be cash, receivables, inventories, bills receivables, etc. So by definition, within 1 year, more than 1 year. So if you can see the slide also, the same meaning is mentioned. Over here, they are taking the name of tangible and intangible non-current assets. Students, we will be looking into the tangible and intangible non-current assets in our further papers of ACCA. By definition, tangible assets are those assets which do have physical existence, which can be seen and touched. Say, for example, furniture, motor vehicles, any kind of equipment, machinery, non-current assets, tangible assets. In accounting standards, IS 16 deals with tangible non-current assets. IS 16, property, plant and equipment deals with tangible non-current assets. Then we have intangible non-current assets. These are the assets without any physical substance, but still generating benefits for the business. Say, for example, brands. Say, for example, goodwill of the business. They do not have any physical existence, but still help the business to generate economic benefits. Say, for example, rights which we attained with the help of a franchise. So these are intangible assets without any physical existence. So in international accounting standards, IS 38 deals with intangible assets. And both of these are included in our syllabus. But right now at the moment, because you are at the initial level, we are not going to be going into the depth of these standards. And with their names also, you will not be judged in the exam, okay? Because you are so young for that. So any tangible or intangible, assets can be included in the definition of non-current assets. On the other hand, assets which are expected to be realized in the business, not the normal course of trading. Whatever the normal course of trading the business is having, whatever assets are going to be realized in those are known as current assets. And over here, they mean to say about inventories. Whatever we are going to sell and purchase in the normal course of the business, inventories are known as current assets. Examples, land and buildings, motor vehicles, plant and machinery do go for non-current assets, and for current assets, inventory, receivables, and cash. I hope that all of you are cleared. Now, one more thing. Non-current assets will be going to statement of financial position, whereas current assets will also be mentioned in statement of financial position ultimately. The ultimate home for non-current assets and current assets is statement of financial position. We do prepare 4 financial statements. Do you remember? Statement of financial position, statement of changes in equity, statement of profit or loss, and other comprehensive income, and the last one is statement of cash flows. So 4 financial statements are prepared. Out of those 4, the ultimate home for non-current assets and current assets is SOFP. Got it? Okay, now let's move on. Anyone having any question? Aisha, Rabia, Mariam?
No, ma'am. Thank you. No, ma'am.
Okay, great. Okay, now liabilities. Students, we have discussed the definition of liabilities also in our last lecture. What are liabilities? In short, we can say that all the obligations and responsibilities of the business are known as liabilities. Whatever responsibilities, whatever obligations or duties the business has in an ordinary course of the business are known as liabilities. So liability is responsibility or an obligation. Same like assets, liabilities are also of 2 kinds, non-current liabilities and current liabilities. Non-current liabilities are those which are going to be realized after the period of 12 months. After 1 year, these responsibilities, obligations, and liabilities are going to be realized. Those liabilities which have to be realized within the period of 1 year are known as current liabilities. Say, for example, if we have or the business have taken a loan and it has to be returned after 1 year, this is non-current liability. If the business has taken a loan which has to be fulfilled, which responsibility has to be fulfilled and has to be returned within 1 year, it is known as a current liability. So those liabilities for which we do get a time to be fulfilling them for a period of more than 1 year are known as non-current liabilities. On the other hand, those liabilities which have to be fulfilled within 1 year are known as current liabilities. So how are you getting it? So 5 elements of financial statements, namely assets, liabilities, equity, incomes, and expenses. For you, Samiha, excuse me. For you, Samiha, I'm repeating. The home of assets, liabilities, and equity is SOFP. Income and expenses go into statement of profit or loss. Got it? So 3 elements. Their last home is SOFP, assets, liabilities, and equity. And the other 2 incomes and expenses do go in statement of profit or loss, also known as SOPL. Got it? So they say that liabilities are claims on the business by outsiders. As I have explained the accounting equation also, they say that liabilities are claims of the business by outsiders. Maybe not in your class. I have not explained about the accounting equation. We are going to come to this point when we will be discussing the accounting equation, my dear students. Okay. So up till now, you can just keep in your mind that liabilities are obligations of the business. Here they are explaining a much elaborated point of view. They are telling us that liabilities are claims on the business by outsiders. What does this statement mean? We are going to come to it back. But when we are going to discuss the accounting equation. Further, they say that non-current liabilities are long-term liabilities payable more than 12 months after the reporting date. What is the reporting date? It is a date at which the financial statements have to be published. That is a reporting date. And normally it is a 12 months time period. The organizations can prepare their financial statements for a period of more than 12 months, for a period of less than 12 months. But normally an accounting period is for 1 year. And reporting date is a date at which the financial statements are published so that the users can analyze them. Current liabilities, those liabilities which are payable within 12 months of the reporting date. What can be the examples of current liability, students? If receivables are the example of current assets, then payables are the example of current liabilities. Payables are those persons from whom the business has purchased something on credit and promised them to pay in the future. So if receivables are the examples of current assets, then payables are the examples of current liabilities. And non-current assets, non-current liabilities can be any obligation which has to be fulfilled for more than a year. It can be a bank loan, it can be a long-term bank loan, which is going to be returned after the period of 12 months. Got it? And where do current liabilities and non-current liabilities go? Same like assets, they will also be going to the statement of financial position. Here is understanding number 2, students. They are requiring us to classify the following items into current and non-current assets and liabilities. There are 6 items given to us, and they are asking us that which one of these are current assets, which one of these are non-current assets, current liabilities, and non-current liabilities. The first one is land and building. First, tell me that whether land and building is an asset or a liability. Asset. It is an asset. Very good. Because it is a resource which will be used within a business in order to increase economic resources. Land can be any kind of plot, any kind of property, which is vacant. There is no building, there is no factory, nothing is maintained on that. Building can be any kind of office, any kind of production unit, any kind of point where the business is running its activities. So land and buildings are tangible, non-current assets. Will be used within a business for more than 12 months and have a physical substance. That is why tangible, non-current assets. Receivables. Receivables are the persons from whom, whom have purchased the business from the business on the basis of credit. These are the persons who are purchasing something from the business on the basis of credit. Say, for example, if Samiha comes to me and asks me that, ma'am, you can, I want to buy something from you, but I would not be paying you right now at the moment, will be paying you in the future. So Samiha is receivable for me because I have to receive an amount from her in the future. So receivables are all those persons who have purchased anything from the business on the basis of credit. They have promised the business to be paying in the future. So receivables are assets because these are the resources with the help of which business is going to earn a profit. So receivables are assets. But which kind of assets? Current assets. Businesses do not give an opportunity to the normal receivables for making the payment of for more than 12 months. Within 12 months, they have to pay back. Then cash. Cash is again a resource which can be used within a business in order to earn profit. And because it is going to be coming and going again and again from the business, that is why it is current asset. Then students, loan repayable in 2 years' time. So loan repayable is a liability. But because it has to be paid for the period of more than 12 months, that is why it is a non-current liability. Very good. Then payables. Payables are all those persons from whom the business has purchased something on credit. Say, for example, AFAC is a supplier. I go to AFAC and say that, please, I want to purchase few things from you, but I will be paying you in the future. So for a business, AFAC is payable now because the business has taken an obligation to pay him in the future. So payables are liabilities. Liability obligation has arisen when the business purchased from suppliers or anyone on the basis of credit. So because the business is not going to be allowed for paying the payables for more than 12 months, that is why payables are current liabilities. Delivery van. Van is again an asset. It is being used in the business to deliver goods. That is why it's an asset. And it is a tangible non-current asset because it will be used within a business for more than 12 months. Got it? So land and buildings, tangible non-current assets, receivables, current assets, cash, current asset, loan repayable in 2 years' time, non-current liability, payables, current liability, delivery van, non-current tangible asset. Everyone cleared?
Yes, ma'am.
Yes, ma'am. Yes, ma'am.
Great. Now, students, there are some important accounting concepts. These are the concepts which you have to keep in your mind while doing the accounting work. when you will be doing the numericals, these concepts should have to be kept in your mind. Whatever accounting work you will be performing in your whole life, these concepts should always be kept in your mind. These are the concepts on which accountancy, financial accounting lies upon. The first one is materiality. Material item or materiality is the concept which tells us that all the items are material if they have a capacity to affect the economic decisions of the users of the financial statements. Anything is material if it is having a capability to influence the decisions taken by the users of the financial statements. I repeat, if you want to write, you can. All the items are material if they are having a capacity to influence the decisions taken by users of the financial statements. Say, for example, I am a business and I am producing my financial statements. And my business is very big. It is having $1 million of turnover for every month. If, say, for example, I skip $1 of a sale from my financial statements, it is not going to have any effect on any of the users of financial statements because $1 is very petty amount. So if I am going to skip $1 million of a transaction from my financial statements, then it is a material one. Then users of the financial statements will not be able to reach the appropriate decision by having a look at the financial statements. So this is the concept of materiality. Anything is material if it is having the capacity to influence the decisions or analysis taken by the users of the financial statements. This is the concept of materiality. IS1, presentation of financial statements, tells us that we are not allowed to skip any item, whether material or immaterial, from our business records. By telling you the definition of materiality does not mean that you are allowed to skip immaterial items from the financial statement. Whether material or immaterial items are present, you are not allowed to skip any one of them from your financial statements. But material items are those, if they are going to be skipped, users are going to be affected adversely. Immaterial items, even if skipped, the users of the financial statements are not going to be affected in a bad manner. Got it? Okay then, substance over form. This is a very important concept, students. Substance over here means economic substance. And form over here means legal form. This is the language of standard itself. Substance over form means economic substance has a priority over legal form. In financial accounting, economic substance of the transactions is more important than the legal form of the transactions. In all the other subjects, in all the other fields, you will be learning that law has a priority over everything. But while making financial statements, we do say that economic substance of the transaction will be having a priority over to the legal form of the transactions. Now, to go into the detail, there is a much more broader concept which you might not be able to understand fully at this point. But let me just give a fair try for that. Do you have any idea about shares? Shares which we do purchase in a business in order to earn profit? Now, shares are normally of two kinds: preference shares and non-preference shares. Or you can say redeemable shares and irredeemable shares. Whenever the shares are purchased by the shareholders in the businesses normally do not promise the amount of shares to be returned back to the shareholders at any point during the life of the company. If, say, for example, Samiha comes to me and she says that, ma'am, I want to purchase the shares of your business, the amount which I will be taking from Samiha, I will not be promising her that amount to be paid back during the life of the business. This is the normal thing in the businesses. These kind of shares are known as irredeemable shares. Now, by economic substance, irredeemable preference shares are having actual definition of shares. So we will be categorizing them under shares. But on the other hand, sometimes in the life of the company, when the shares are purchased, the shareholders are promised to get back that amount of share during the life of the company. Got it? Say, for example, Samiha comes again to me and says that she wants to purchase the share, and I say that, okay, you can purchase a share and you can purchase an irredeemable share so that during the life of the company, the amount which you have spent to purchase the share can be returned back to you. Now, by name, it's a share, but by definition, it's a loan. Because it's the characteristic of a loan that it is going to be returned during the life of a business. But for share, it's not the definition of a share. By name, it is going to remain a share, but its economic substance is that of a loan. So in financial accounting, that share will be categorized as a loan. We are going to categorize it as a liability of the business. By name, it is a share, but still it is a loan of a business. So that is where, and most of the times in the financial statements, you will be having a look further that economic substance will be having a priority over to the legal form. Whatever legal form is there will be neglected for the time being because financial reporting has a responsibility towards users of the financial statements. Their analysis is more important for the persons who are making the financial statements. My online students, are you clear about the concept?
Yes, ma'am.
Okay, so economic substance will be having a priority over to the legal form. The third one, the going concern assumption. Students, going concern in financial accounting means for the period of more than 12 months. Whenever the financial statements are going to be prepared, whenever the business transactions are going to be written, it is assumed that the business will be running for the period of more than 12 months. If, say, for example, the business comes to know that our position is very weak and we would not be able to run the business for more than 12 months, then they have to prepare the financial statements on breakup basis so that the users of the financial statements will not be adversely affected. Users must be knowing that business is having liquidity issues and may be liquidated within 12 months. Anyhow, when the financial statements are prepared, they are prepared on the assumption that the business will be running for foreseeable future. Foreseeable future in accountancy means, it's a jargon basically for accountancy. It means for the period of more than 12 months. Got it? Then business entity concept. This one is very important when you are going to take a start in passing accounting entries for the syllabus which I have given you, the papers which I have given you. Business entity concept means that whenever you are going to pass the transactions, this is N. These will be passed from the point of view of a business. We have discussed a separate entity concept, separate legal entity concept, in which I told you that the shareholders of the business will be considered as separate from the business itself. Say, for example, if I am the owner of a business, I am the shareholder, and I have started a business. The business is separate and I am separate. If the business is having any kind of loan, responsibilities, any kind of obligations, those have to be fulfilled by the business, not by the owner. Because limited liability companies have limited liability. For fulfilling the obligations of the business, owners do not have any responsibility. This has to be shown while passing accounting transactions also. We are going to pass the transactions from the point of view of a business, not from the point of view of shareholders, not from the point of view of the management, and not from the point of view of anyone. If capital is invested in the business, it is going to be coming into the business, not into the pockets of shareholders. If liabilities are going to be fulfilled, they are going to be written in such a way that they are keeping away the resources from the business itself, not from the pocket of the shareholders. So whenever the accounting event, business event is going to happen and we have to pass the transaction for that, we have to consider that it is happening from the point of view of the business. Capital is invested within a business, not to the shareholders. Capital is not given to the shareholders. To the business it is given. So we are going to consider a business as a alive person. Everything will be passed away to the business and will be coming to the business. Not to the shareholders, not to the management, not to the accountant, not to anyone. Got it? This is a business entity concept. Accrual basis of accounting. This is again a very much important concept. Accrual basis of accounting. There are two bases of accounting. Cash basis of accounting and accrual basis of accounting. Cash basis of accounting tells that we have to pass the transactions on the basis of cash received and cash paid. Say, for example, expenses have to be recorded when they are actually paid in the form of cash. Income has to be recorded when it is actually received in the form of cash. This is a cash basis of accounting, which is not followed under international financial reporting standards. Cash basis of accounting is not followed in the International Financial Reporting Standards. International Accounting Standard Board, IASB, does not allow us to do that. We have to follow accrual basis of accounting, which tells us that expenses have to be recorded when they are incurred, whether paid in the form of cash or not. Income has to be recorded when it has been earned, whether received in the form of cash or not. If the expense has incurred and it has become our obligation, whether we have paid it in the form of cash or not, we have to record it in our concerning accounting period. Same is the case with the income. When the income is generated, it has become our right. Whether it is received in the form of cash or not, we have to record it. Say, for example, just giving you an example to understand this concept. Electricity bill. Say, for example, in this month, I have used 10 units of electricity, but the bill will be coming after a month. After a month, the bill is going to be coming for this. But because I have used that electricity, it has become my obligation. I have to record it within this month, whether paid in the form of cash or not. It is the expense of this month. Say, for example, the laborers are working in the organization. For a whole year they work, and we do say that in the next year we are going to pay you. But while recording the transactions, we are going to record this expense within this year. We are not going to wait for the actual cash outflow. This is accrual basis of accounting. Same is the case with the income. Whatever income has become a right of the business during an accounting period has to be recorded, whether received in the form of cash or not. Got it, everyone? This is accrual basis of accounting. There is only one financial statement which follow cash basis of account, and that is statement of cash flows. We have 4 statements, students. Statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows. This is the only statement which is prepared by following cash basis of accounting. All the others do follow accruals basis of accounting. This is the only statement which considers that transactions will be recorded when cash is actually going to be inflowed and outflowed from the organization. All 3 statements consider that income has to be recorded when it has become the right of the business, whether received in the form of cash or not, and expenses have to be recorded when they are incurred, whether paid in the form of cash or not. This is accrual basis of accounting. Is everyone cleared?
Yes, ma'am.
My online students?
Ma'am, can you tell me about the going concern assumption?
Yes. Going concern assumption tells us that whenever we are passing the accounting transactions, we have to assume that business will be running for the foreseeable future. We will be assuming that our business will be running for the period of more than 12 months. It is not going to collapse within 12 months. This is going concern assumption. Got it?
Yes, ma'am.
Great. Now, prudence. What is the meaning of being prudent? What is the dictionary meaning of being prudent or prudence? Careful. We have to adopt a careful attitude while passing accounting transactions. Why this careful attitude has to be followed? Because incomes and assets should not be overstated. Losses and expenses should not be understated. Prudence concept tells us that while we have to pass the accounting transactions, we need to be careful that our income and assets are not overstated and our expenses and liabilities are not understated. Any kind of loss which is probable to happen should be recorded in our statements. If there is any kind of loss which we are expecting to be materialized, is going to be recorded in the financial statements. But if there is any income which we are expecting to be realized, will not be recorded in our accounting transactions. So prudence concept tells us that we have to be diligent while passing the accounting transactions so that our income and assets should not be overstated, while our expenses and liabilities should not be understated. Any kind of foreseeable loss will be recorded, but any kind of foreseeable income will not be recorded. Got it? This is just a prudence concept. And the last one is consistency. Consistency means a consistent attitude, a permanent attitude. Whatever we are following in year 1, we have to follow it in year 2 and other periods as well. International accounting standards do want this consistency to be maintained so that the financial statements can be compared with each other. Do you remember comparability principle? We have discussed the qualitative characteristics, enhancing qualitative characteristics. There are total 6 qualitative characteristics which should be present. Do you remember, students?
Yes, ma'am.
2 are
There was
the basic ones and 4 are enhancing qualitative characteristics. And one enhancing qualitative characteristic was comparability. The financial statements have to be prepared in such a way that they can be compared with the competitors and within the organization with their own budgets, plans, or the previous year's transactions. Now, if the financial statements are prepared on the same rules, on the basis of same rules and regulations, then they are consistent. If every year the policies, rules and regulations are changed, they are not consistent and they will be lacking the principle of or the characteristic of comparability. So whatever rules and regulations are being followed, if not necessary, they are not going to be changed. Sometimes when you are going to prepare the financial statements, you will find out that there are different principles which can be followed. There are different policies which can be followed. But IS 1 tells us that whatever rules and regulations, whatever policies you are following in current year, it is good enough if you are going to follow that in future years as well. So that they can be consistent and comparability can be. So these are the important concepts. I hope that all of you are cleared. Go through the slide once again. You ask yourself whether you are cleared or not of all the principles, of all the concepts. Is any problem of all? AC is not working now. Even I am feeling the same. Is it the first day that you are feeling AC is not working?
Yes.
I do feel every day. We can just request them to change the room. Because even for the slides also, I sometimes feel that they are not quite visible. Is it? It's as per your feasibility, my dear students. You are the customers. So whatever you are going to want, it's going to happen. So if you feel problem, you can just tell Mr. Helpin to do that. For me, it's fine because for me, it's visible. But if you are uncomfortable, you can just tell me, we can have a look at it. Now, my dear students, everyone understood the material, the concepts, the accounting concepts? If anyone is having any problem, please do ask, or we can start this understanding 3. Okay, now the requirement of the question is, which of the following statements are correct? More than one can be a correct statement. Maybe one statement is correct only. Maybe none of them are, no, none of them is not an option. So maybe 1 or 2 statements are correct at least, or all of them may be correct also. So number 1, only tangible assets. They have given us an example. They have given us the definition of tangible assets, those with physical substance. Only tangible assets are recognized in the financial statements. Is this true? This is not at all true. In the financial statements, we can have intangible assets, we can have current assets, we can have liabilities, we can have equity, we can have incomes and expenses also. So this one is not correct. Second one, faithful representation. Students, do you remember faithful representation? One of the basic qualitative characteristics. That everything which is represented must be giving a true and fair view of the actual transactions of the company. Faithful representation means that the commercial effect of the transaction must always be shown in the financial statements, even if this differs from the legal form. Is this true? Is this the meaning of a faithful representation? This is a meaning of substance over form. Faithful representation means that whatever is happening during an accounting period must be represented truly and honestly without any biasness. We do know that it is also mandatory that legal form of the transactions will not be having a priority over to the economic substance. This is true, but this is not the meaning of faithful representation. Getting my point, students? Faithful representation means that true and fair view of the actual transactions of the company must be stated honestly and objectively. Honesty means truthful. Objectivity means without any biasness, giving favor to one thing and giving no favor to the other thing. This is the meaning of faithful representation. Yes, dear, please ask. Please. Faithful representation is also required. And this is not the meaning of the faithful representation.
I mean, it should be quality of financial statements, right?
Yes, it should be the quality of the financial statements. But it is not the meaning of the meaning which they have represented. It is substance over form. The definition that the commercial effect of a transaction must always be shown in the financial statements, even if it is differing from the legal form. This is substance over form. This is not the meaning of faithful representation. Got it, is it? Faithful representation simply means that with honesty and unbiased behavior, the transactions have to be recorded. While substance over form means that commercial effect of the transaction, economic substance of the transaction will be having a priority over to the legal form. Getting it? The next point. So this one is not correct. This one is also not correct. Third one, businesses only report transactions, events and balances that are material to the users of the financial statements. Is this correct? Only material items have to be reported? No, this is again wrong. So none of them is the correct one. It means that this is wrong. The correct one is none of them is correct. There can be mistakes somewhere also. So that's why your skepticism is very much highly required.
There is no option of none of them.
Yes, my dear?
There is no option of none of them, only A, B, C, D.
Yes, that's why it's wrong, because none of the answers is right.
Maybe the question, which of the following statements are incorrect? So all of them can be option.
Yes, maybe there is a mistake. In few questions of ACC, I have seen the mistakes, not all of them. In my previous courses also, there are few mistakes, because whenever we see a mistake, we update ACC and they do, update the course also. But there are few mistakes again. When we are going to do the questions, I will be telling you. Okay. So none of the answers is correct. The first one, we do know it's wrong. The second one, faithful representation, honesty and unbiased behavior. The definition which has been given, it's substance over form. And the third one, it is not going to happen that only material transactions we have to record. Immaterial are also going to be recorded. Got it? Have a look at this question once again. Aisha, Rabia, are you cleared?
Yes, ma'am. Yes, ma'am.
Aisha and Rabia, do you have any plan to physically attend the classes?
Yes, ma'am, inshallah soon.
From when?
Ma'am, it is very far away, and when I will get my license, inshallah. So yeah, maybe in second semester I will start, or in the end of December.
Yes,
start
not
from
in the end of December. If you can start in the start of December.
Okay, ma'am, inshallah.
Because in December we will be starting our mocks.
Okay,
mock exams are going to be started. So that is the point from where the practice is going to be started.
Okay, ma'am.
Okay.
Okay.
So can I move on, students? Yes, Maria, do you want to say anything?
Yes, can you tell me what are tangible assets? This is a non-current asset, right?
Tangible? No, yes, tangible are non-current assets. Yes, dear.
Why this one is wrong?
They say that only tangible assets are recognized in the financial statements. We do have other items also to be recognized in the financial statements, not only tangible assets. We do have income, expenses, intangible assets, and equity, liabilities too to be recognized in financial statements. Got it?
Got it, thank you.
Sorry?
Got it, ma'am.
Got it, okay, that's great. So can we move on, students? Samiha, have you understood here? Okay, now, this is about which Heather was asking yesterday, regulatory framework. Students, regulatory framework is a framework for financial accounting. When we do have to perform any work in the financial accounting, we have to follow this regulatory framework. This framework gives us the rules and regulations to be followed in the financial accounting work. So regulatory framework, a set of rules and regulations are going to be provided to us from different authorities, which have to be followed while performing the work of financial accounting. have to perform in the financial accounting comes from two major sources. From the national regulations and one from the international rules and regulations. National regulations of a country will be having a priority to the international regulations. Whatever national rules and regulations are in place will always be followed on a priority over to the international regulations. Whatever our country government is expecting us to do has to be given a priority over to the international rules and regulations. If something coincides in national and international rules and regulations, a person will be following its national rules. Say, for example, if there is a law in your country, you have to follow that country law instead of following any international law. When you will be traveling internationally into any other country over there, then you have to follow that particular international law. When you are within your country and when you are making the financial statements in your country, then you have to follow national rules and regulations regarding financial reporting. If at any point national rules and regulations and international rules and regulations are the same, then the debate ends. But when they are coinciding, then the priority will be given to the national rules and regulations. One such rules and regulations do come from IASB, International Accounting Standards Board, is present in United Kingdom. It has an authority to produce the reporting standards to be followed while making financial statements. For us, for UAE, for India, for Pakistan, for any other Asian country, for China, for Japan, all of these reporting standards which are produced by IASB do not have a priority over to our national rules and regulations. If national rules setters are going to pass the reporting standards produced by IASB in their own country, then they will be having a significance. Otherwise, if national setters are not following IASB rules and regulations, then locally we do not have any responsibility to follow them. IASB produces international accounting standards and international financial reporting standards. IAS, International Accounting Standards, IFRS, International Financial Reporting Standards. These are produced by International Accounting Standards Board. If in your country, these are followed because your country national preparators of law have passed a resolution with IASB that they will also be following IFRS and IAS, then you have to follow them. Otherwise, if you are present in a country in which IFRS and IAS are not followed, then you do not have any responsibility to follow them. Say, for example, in America, still IFRS and IAS are not followed. They do follow GAAP, Generally Accepted Accounting Principles. In Pakistan, international financial reporting standards are followed. In India, still they are in confusion. Generally accepted accounting principles are followed and they are into the process for following IFRS. In UK, IFRS are followed. In Australia, in Canada, IFRS are followed. So in most of the countries of the world, we are following international financial reporting standards. The old name for IFRS was IAS. Before to some time period when IASB used to present any kind of standards, they do come with the name of IAS. Now, when the standards are updated, they are coming with the name of IFRS. All the new standards which you are going to find will be with the name of IFRS. Say, for example, when I say IAS 1, that is an old standard. That is why its name is IAS still. If it is going to be updated, if the new standard is going to come, it will be coming with the name of IFRS. Got it? So this is a regulatory framework that while making the financial statements, what are we required to follow? We being the financial accounting student of ACCA, we will be working on international financial reporting standards. With GAAP, generally accepted accounting principles, there is a little bit difference. Got it? So if you want to work in America, then when you will be going over there, you have to pass their 2 papers in order to get their chartered accountancy. Got it? So regulatory framework for financial statements, for preparing financial statements, you have to follow national standards and regulations, and you can follow international standards and regulations. If both of them are coinciding, then you will be going for your national standards. The company law in your country is always going to have a priority over to the national standards. In regulatory framework, we will be discussing about corporate governance. Once again, in a slight detail, purpose and objective of corporate governance and the difference in the ownership and control. We are going to discuss it. Why a regulatory framework is necessary? Why do we want to have some regulations in order to prepare our financial statements? Ordinary and generally, we do know that regulation is important so that comparison among the financial statements can be made. If everyone is following the same standard, then comparison and consistency can be maintained. If everyone is following a different thing, then it will become a mess. Got it? They say why the regulatory framework is necessary to ensure that the needs of the users of the financial statements are met with at least a basic minimum of information. Whatever users of financial statements are requiring, at least minimum of it should be given to them. And every company in a country will be having a liability to follow a same regulatory framework so that all the users of the financial statements can get an information to the minimum level, whatever they are requiring. Got it? Then to ensure that all the information provided in the relevant economic arena is both comparable and consistent. Given the growth in multinational companies and global investment, this arena is an increasing international one. So because so many companies are coming to, increase their growth, they are expanding so that they can flourish. So many companies are coming. Now, every company, if they are following their own different rules and regulations, it becomes difficult to make the financial statements comparable to each other. So just to maintain the principle of comparability and consistency, we have to follow the regulatory framework. Then, to increase users' confidence in financial reporting process. Users of the financial statements are obviously going to be confused if every financial statement is having different kinds of rules and regulations. If in one financial statement, different line items are present, and in other one, different items are present, then it becomes difficult for the users to understand. Got it? So that is why to increase their confidence in the financial reporting, it is necessary that the financial statements will be maintained on the basis of same regulatory framework. Got it? Then students, to regulate the behavior of companies and directors towards their investors. Regulation of the behavior of companies and directors towards their investors is very important. It is again the basic point which tells us, which leads us to the difference in ownership and control. Owners of the business are investors, whereas directors of the business are managers of the company. Owners of the company must know that financial statements will be prepared on the basis of some rules and regulations. They can expect minimum line items to be presented in the financial statements. And the directors of the organization must know that if any of the line item which is mandatory to be added will be missing, the investors are going to question us. So to regulate the behavior of the companies and directors, so that directors cannot defraud the investors, it is necessary to follow the regulatory framework. to follow the principles given to us by ISB or any kind of national or international regulation. Got it? So accounting standards on their own would not be sufficient to achieve these aims. In addition, there must be some legal and market-based regulations. So only accounting standards, IAS and IFRS, are not sufficient to maintain this principle. We do need some legal and market-based regulations, some national regulations also. Got it? Are you clear that why regulatory framework is necessary? Now, which regulations make your national law? Which rules are going to make the national regulations? It can be national financial reporting standards. There can be some reporting standards which are issued nationally. Got it? Which normally most of the countries are always going to be followed if they are having a handshake with the international accounting standards. Otherwise, no. Got it? But still, if there are national rules and regulations or national standards coinciding with the international ones, the priority will be given to the national standards. Got it? National law, the country law, is always going to have a priority. Market regulations. When the companies deal in a market, obviously some rules and regulations do prevail, do come into existence. And those market regulations will also be making some rules and regulations if they are going to be coinciding with the international rules and regulations. We have to look into detail. If they are same, then no problem. And mostly they are same. Security exchange rules. Security exchange is present in every country, which is present in order to ensure that sales can be purchased and sold through them. It's a market for the purchase and sale of the shares. If any public limited company wants their shares to be issued to the public, they have to get a listing of the security exchange, the stock exchange also. So if they are not going to get a listing in the stock exchange, obviously they will not be having an authority to sell and purchase the shares publicly. So in order to get the listing in the security and stock exchange, the companies do have to ensure that the national and international rules and regulations are followed. So anyhow, national laws can come from the security exchange rules as well. Got it? The stock exchange and security exchange can also make national regulatory frameworks. The next one, yes, dear.
I want to ask, in the UAE, which standard is used to prepare the financial statements? In the UAE, which standard is used? Is it of national or international?
No, we are going to follow IFRS because in most of the countries, the IFRS are applicable now. The national regulations have shaken their hand with the international reporting standards now.
Okay.
Got it? Like Mariam, in Pakistan also we follow IFRS now.
Because ma'am, you said for IFRS we need to pass 2 more papers, is it?
No, I didn't mean to say that. I said that if, say, for example, you have to work in any other country where IFRS are not followed, then you are going to pass the papers from their financial reporting standards area. Got it?
Got it, ma'am.
So in order to complete your ACCA, there is nothing that you are going to pass more 2 papers in order to get a know-how of IFRS. In ACCA, there are IFRS applicable. Clear now? Because they are coming straight away from me. Now, this is not the new concept for you, company ownership and control. When we say that we do want regulations in order to regulate the behavior of the directors towards the investors of the company, then we should be looking to this concept as well. That company ownership and control do lie in 2 different hands. The persons who are owning the company are known as shareholders of the company. The persons who are managing the operations of the company are known as directors of the company. So there is dilution of control in the companies. The control is given or directed to the directors of the company. There is a separation of ownership and control. The persons who are owning the company are not the same as the persons who are managing the company. Got it? So shareholders are the owners of the company. They are the persons who will be delegating the controls to the directors to control the company. Shareholders of the company are principals. They are the persons who are going to give the authority to the agents so that these agents, the directors, can control the company on their behalf. Shareholders are the principal and directors are the agents of the company, because directors will be working in the company to ensure that shareholders' objectives are met. This is known as an agency relationship. But directors are also very clever. They do start working for their own objectives instead of working for the objectives of the shareholders. When this situation exists, there is an agency problem. What is an agency problem? When directors of the company start working for their own objectives instead of working for the objectives of the shareholders, then agency problem is going to arise. And in order to control this, there is a corporate governance code which needs to be followed. In order to ensure that shareholders of the company's objectives are going to be met, instead of meeting the objectives of directors, we need to follow corporate governance. For corporate governance, all of the countries around the world are working to ensure that companies are directed and controlled in a best possible manner. Corporate means company, governance means the way of direction and control. So all of the countries around the world are working to ensure a good corporate governance. UK is also working towards it, and United Kingdom has issued a UK corporate governance code in order to maintain good corporate governance in the companies. Before to some time, my dear students, what used to happen? The shareholders of the companies used to be very satisfied by looking at the financial statements that the companies are running in a well manner. But after some time, they see that the companies are collapsing. They used to be astonished at that time that whatever their idea about the company is absolutely wrong. They thought by having a look at the financial statements that company is running very well. But after some time, the companies used to collapse. That is why in UK and USA, proper working has been carried on. In UK especially, a committee has been formed whose name was Cadbury Committee. Cadbury Committee has been formed in order to look into the issues. That why is it so? That within a blink of eye, the companies used to be collapsed, which according to the shareholders are performing very well. After some time, Cadbury Committee come up with a report which is known as Cadbury Report. And Cadbury Report came up with the issue of weak corporate governance. They said that directors of the company are not giving a true and fair view of the actual transactions of the company to the shareholders. That is why the shareholders are blind about the actual performance of the company. That is why the corporate governance in the company should be a strong one. Got it? So, according to Cadbury report, the definition of the corporate governance is the way in which the companies are directed and controlled. This is a definition of corporate governance as per Cadbury Committee. What your book says about corporate governance, they say Cadbury Report 1992 provides a useful definition. The system by which the companies are directed and controlled. And what is the theory behind this Cadbury Report I have told you? There has been a committee formulated in order to gather the insights that why the companies are collapsing. So Cadbury Report tells that the companies used to collapse because there is a weak corporate governance. And that is because of separation of ownership and control. So there should be a best way to control the company and to direct the companies. As per Cadbury report, the system by which the companies are directed and controlled is known as a corporate governance. And UK, in order to ensure a better corporate governance, what do we have? UK Corporate Governance Code. Got it? Corporate Governance Code is there in order to ensure that the companies are run and directed in a fair manner. Further, they say an appropriate expansion to this definition might include in the interest of the shareholders and in relation to those stakeholders beyond the company borders. So the use of the term stakeholders suggests that companies have a much broader responsibility to the economy and society at large. This includes concepts such as public duty and corporate social responsibility, which is popularly known as CSR. If directors of the company have a responsibility to these groups, then they must also be held accountable to them. Now, students, in order to ensure that companies are directed and controlled in a well manner, the first thing is that financial statements should be giving a true and accurate view of whatever is happening in the company. So that users of the financial statements, not only shareholders, all the stakeholders, all the users of the financial statements will be getting a true and fair view of the actual position of the company. Cadbury report tells us that directors of the company are not only responsible to the shareholders, but to all the stakeholders of the company. Stakeholders are all those persons which are having any kind of interest in the business. Even the management of the business is stakeholder. Creditors, debtors, receivables, payables, banks, government, charities, all those persons having any kind of interest in the business are stakeholders. Businesses, directors have to ensure that they are following the needs and wants of all these stakeholders instead of only shareholders. So nowadays, the responsibility of the directors is not to make sure that the responsibility towards the shareholders are maintained, but they have a responsibility to ensure that the needs and wants of all the stakeholders are met, and this is CSR, corporate social responsibility. Companies are not only responsible for shareholders, but all the stakeholders of the business. What I mean to say over here, that corporate governance is basically initiated in order to secure the rights of the investors. But now corporate governance is extended into the concept of CSR, which means that now the directors of the company are not only responsible to the shareholders, but all the stakeholders of the company. Got it? And in order to ensure this, the corporate governance code has been made, which is again a regulation, which needs to be followed while drafting any reporting standards. Got it? Okay, now I do know that this is a dry topic, and regulatory framework has always been a dry topic for all the students and even for me. I used to leave this topic every time, but this topic is necessary for your professional papers. In your professional papers, this is going to be taught to you again. Got it? So they say the basic elements of the sound corporate governance include effective management, effective systems of internal control, oversight of management by non-executive directors, fair appraisal of directors' performance, fair remuneration of the directors, fair financial reporting. This one is concerned to us. Fair financial reporting is one of the objectives to be met by having a good corporate governance and constructive relationship with shareholders. Because of this, we are reading the importance of corporate governance. Because one of the objectives of the corporate governance is to ensure that financial reporting is also fair. There are so many objectives of the corporate governance that the fair remuneration should be given to the directors, whatever they are performing in the company, according to that, the remuneration has to be given to them. Their nomination, their what we can say, their hiring in the company should be on the fair basis. Their performance should be monitored and appraised on the fair basis. The audit of the financial statement should be done in a better manner. So there are so many, means of maintaining the corporate governance, and there are so many objectives of maintaining the corporate governance. But the objective which is relevant to us is fair financial reporting. We want the reporting to be fair enough, which is leading us to the same concept of fair representation. Got it? Now, regulatory framework is ended. And now the dryness of the subject is over. There is least theory left in all of our financial accounting now. We have covered almost all of the theory of financial accounting. Now, students, we are going to discuss this and the next slide, and then we can have a break, okay? Capital expenditures and revenue expenditures. It is necessary to differentiate among capital and revenue expenditures, because when you will be doing the financial accounting work, you will be requiring this distinction to be made. What are capital expenditures? All those expenditures which you are doing for the purchase of non-current assets are capital expenditures. All those expenditures which are non-routine in nature, which do not be incurred on the day-to-day basis of the business, are known as capital expenditures. All of the expenditures which you are making to purchase a non-current asset or to enhance the performance of a non-current assets are known as capital expenditures. I repeat, all those expenditures which you are doing to purchase a non-current asset or to improve its performance are known as capital expenditures. All those expenditures which are frequent in nature, which are happening on day-to-day basis in a regular manner, which are not on the purchase or for the improvement of the non-current assets, are known as revenue expenditures. These are done to maintain the performance of the non-current assets. These are done to improve the non-current assets. Capital expenditures for purchase and improvement of non-current assets. These are to maintain the non-current assets. This is a proper distinction. Why it is necessary to make a distinction? Because capital expenditures will be going to the statement of financial position. Revenue expenditures will be going to the statement of profit or loss. That is why it is necessary to differentiate among them. I repeat, capital expenditures are non-routine in nature, will not be done in the ordinary course of the business, will be done for the purchase of a non-current asset or to improve the performance of the non-current asset. Revenue expenditures are going to be done in the ordinary course of the business, will be frequent and regular in nature, will be done to maintain the non-current asset. Any kinds of repairs are revenue expenditures. Any kind of major expenditures for the improvement of a non-current asset are capital expenditures. Say, for example, if you are making one new room in this university so that more students can be catered in, that is a capital expenditure, because this is being used in order to improve a non-current asset. If, say, for example, you are painting this building, it is not going to improve a non-current asset, it is just for maintenance of the non-current asset. That is a revenue expenditure. So repairs to the existing non-current asset are revenue expenditure, while improvement of the non-current asset are capital expenditures. Got it? They say for capital expenditure, benefit is enjoyed for more than one financial year. They are long-term in nature. For non-current assets, we do enjoy the benefit for more than 1 year. Usually, large budgets occur occasionally. They are not day-to-day. Examples include purchase or construction of fixed assets. Fixed assets are also known as non-current assets. Expenditures incurred to increase the useful life of the fixed assets, software development expenditures, etc. On the other hand, revenue expenditures, benefit is enjoyed within one financial year because they are just for maintenance. Usually small budgets, small amounts usually are going to be encountered in these. Examples include, they occur routinely. Examples include depreciation, carriage, repair and maintenance, stationery, selling and marketing, administration, financial charges, etc. Got it? Why the differentiation is necessary to be made? Because revenue expenditures will be going to the statement of profit or loss, whereas capital expenditures will be going to the statement of financial position. This slide we are going to do before a break. Now, students, examples of the capital and revenue expenditures they have given. Buying a van is a capital expenditure. It is the purchase of a non-current asset. It is a capital expenditure. Petrol costs for the van, they are routine in nature. We are not improving the non-current asset by having a petrol in it. It is just maintaining the position of a non-current asset. It is a routine nature expense. So it is a revenue expenditure. Van will go to the SOFP. Petrol cost will be going to the SOPL as an expense. Got it? Repairs to the van. This is just a repair. It will just maintain the capacity of a van. It will not be enhancing the or improving the performance of a van. It is revenue expenditure. Then putting extra headlights on the van. Now it is an improvement. Putting extra headlights on the van. If one headlight has been broken and we are just repairing it, it's a revenue expenditure. But putting extra headlights on the van, it is now improving the performance. It is capital expenditure. Got it? Buying machinery, capital expenditure. Got it? Yes, Aisha, Rabia, are you cleared?
Yes, ma'am.
Why so dull? We can have a 15 minutes break. Is 15 minutes enough?
Yes,
enough?
Yes,
No?
ma'am.
20 minutes?
Ma'am, please 20 minutes.
Actually, I wanted to complete this slide so that after the break, we can start with double entry. Okay, after the break, we are going to start. Are you there?
Yes, ma'am.
Yes, ma'am.
Okay, good. Students, without any time wastage, we are now going to start the concept of capital and revenue receipts. These are just opposite to the capital and revenue expenditures. Capital receipt is a non-routine receipt. Whatever we are going to receive in a non-routine manner, in occasionally manner, we are going to call it as a capital receipt. In short, we can say that when we are selling any non-current asset and we are receiving something out of it, it is known as a capital receipt. It is a non-routine receipt. We are not receiving it in a frequent manner. We are not receiving it in a regular manner. It is known as a capital receipt. On the other hand, revenue receipt is the receipt which we are having in a routine manner, in an ordinary course of the business. On the daily manner, we are receiving something, we are receiving some earning, we are receiving some income. It is known as a revenue receipt. All the revenue receipts will be taken as an income to the statement of profit or loss. All the capital receipts are going to be taken to the SOFP. This is why it is important to take a distinguishment in both of these. Got it? So we are going to make a difference among these because capital receipts will be taken to the SOFP, whereas revenue receipts will be taken to the statement of profit or loss. They say capital receipts comprise of contributions of capital into the business by the proprietor, partners, or shareholders. Say, for example, any investment which is made by the investors in the company or partners into the partnership business or sole proprietor into the sole owner business, it is known as a capital receipt, because business is separate from the persons owning it. One more thing. Normally, we do apply the separate entity concept in the case of limited liability companies. But while we are going to record the business transactions, this business entity concept will be applied to the sole proprietor. We are going to record the transactions on the basis of on behalf of the business. Got it? On the other hand, we do know that sole proprietorship businesses and partnership businesses do have an unlimited liability, and they are considered as the same as their business. Limited liability companies considered as the separate one. But business entity concept will be applied to all. While recording transactions, we are going to work on the business entity concept. Transactions will be recorded on the basis of business. Got it? They say further, any sums received from debenture holders. Students, normally the companies do issue shares to receive capital investments, or on the other hand, they receive loan also. They receive loan also in order to pursue their activities. So whenever the loan is issued by the company, it is known as debenture. So debenture holders are the persons who are giving the loan to the company. Got it? Then any loans, simply loans if the company is receiving the loan from the bank or any third party. Sale proceeds of any fixed assets and long-term investments. And capital receipts can be received by selling any kind of non-current asset. And the agenda behind capital receipts is that they are going to be non-frequent in nature. They are going to be happening on occasionally basis. They are not going to be happening regularly in the business. And usually they will be involving the substantial amounts. Got it? Small amounts are not going to be there in capital receipts. Come to the revenue receipts or income. Revenue receipts are the outcome of firm's activity in the accounting period. Whatever the normal course of the business is, out of that, if any kind of income is received, it is a revenue receipt. If, say, for example, from any investment, an interest is coming regularly, it is again a revenue receipt because it is regular in nature. Got it? They say money received on sale of goods in trade or on rendering of service. So by giving services or by selling the goods in the ordinary course of the business, it is a revenue receipt. Students, in accounting, goods is a term which is used for the inventory, which is purchased for the purpose of resale. When we do say that we have purchased goods, it means that we have purchased inventory for the purpose of resale. Got it? Goods is a term used for an inventory for the purpose of resale. Got it? While recording, we do call these goods as purchases. With the name of purchases, we do record them. We are going to look into it in further slides. So examples of the revenue receipts are sales commission, any kind of fee received, interest, dividends on investments. What is a dividend? Dividend is a return on shares. Whenever some person purchases a share from any company, the return on that share is known as a dividend. Like the return on loan is an interest. Got it? The dividend is the return on shares. Now, what is the difference between capital receipts and revenue receipts? Their nature is different from each other. Capital receipts are non-recurring in nature. They are non-routine. They are going to happen occasionally. Whereas revenue receipts are recurring in nature. They are routine transactions. Same as the difference between capital expenditures and revenue expenditures also. Capital expenditures are not frequent, whereas revenue expenditures are frequent. Size. Normally and generally, the size of capital receipts is large. The amount which we receive as the capital one is substantial, is large amount. Whereas the receipt which we receive as a revenue one is having a generally smaller size. Distribution. These amounts are not available for distribution as profits. Why? Because the routine transactions income is normally available for distribution as profits in the form of dividends. Whatever capital receipts are, they are normally not generated for the distribution of dividends. Got it? So this is again one of the characteristic differentiating these two. Now, students, we are going to start the double entry system. This is from where we will be learning about recording of journal entries. Whenever in the financial accounting, we are discussing about recording, classifying, and summarizing of the financial transactions, our work starts when the transaction occurs. In the first lecture, I told you people the definition of financial accounting. For Samiha, I'm repeating it. Financial accounting is an art of recording, classifying, and summarizing business transactions for the purpose of analysis. So this is a definition of financial accounting. Our work starts from recording of transactions and it ends on summarizing the transactions. The first step starts when the business transaction occurs. When any kind of transaction occurs between two or more parties, giving rise to any kind of monetary event, we say that the business transaction has occurred. The business transaction occurs and our work starts. Transaction occurs, we have to record it. The first step of the financial accounting starts. We do record those transactions in the books of prime entry. The books of prime entry are 7 in number. The books of prime entry are 7 in number. We do call them as day books also. The other name for books of prime entry is day books. These are namely sales day book, purchases day book, sales returns day book, purchases returns day book, cash book, petty cash book, and the 7th one is journal. We are going to have a look at them one by one. So recording phase is done in the books of prime entry. The other name for books of prime entry is day books. Sometimes in the multiple choice questions, they do ask that day book is the other name of books of prime entry, or the books of prime entry is the other name for day books. Cash book and journal are one of the day books, one of the books of prime entry where recording of the transaction is done. What we do in the recording phase, simply list of daily transactions. We do simply record the transactions as soon as they are occurring. After recording phase ends, we do have a next phase to be started, that is classifying the transactions. Accounting is an art of recording, classifying. The next stage is to classify those accounting transactions which we have recorded in the first phase. We do classify the transactions into the ledger accounts. The first step ends in the books of prime entry. The next step starts and ends in the ledger accounts. But once the transactions are recorded, we have to classify them on the basis of their similar characteristics. Because in the books of prime entry, whenever the transactions are happening, we are recording them. They become in bulk. We then have to classify them. We have to arrange them in a good manner so that summarizing of those transactions can become easier. So in the next step, what we do make the ledger accounts to classify those transactions. What we do, double entry is used to reflect duality of transactions. In order to perform these works, we have to work for double entry system. What we do reflect the duality of transactions while using double entry system, and accounting equation must always balance. This is telling us about the balance sheet. Every transaction, whichever is happening in the organization, will be bringing at least 2 effects. There are 5 elements of financial accounting: assets, liabilities, equity, income, and expenses. Any transaction which is occurring will be affecting at least 2 accounts. At least 2 accounts will be affected. Either both the accounts in assets, either one in asset and the other is in liability, either both in liabilities, either one in income and the other in assets, either one in expenses and the other one in liability, or both in expenses. It can happen. Every transaction which is happening will at least be having two impacts, that is duality of transactions. And this is double entry system. Double entry system is a system which we follow in order to make the transactions complete, in order to show the complete picture. There is other entry system which is known as single entry system. Single entry system refers to the incomplete records. When we are recording only one effect of the transactions, it is incomplete picture. Every transaction which is going to happen will be bringing at least two impacts. That is double entry system. After this step, the third and the last step is going to start, that is summarizing of the records. And summarizing phase leads us to the preparation of financial statements. Ultimately, we prepare 4 financial statements. Those financial statements are published for the help of the users of the financial statements. Namely, 4 financial statements are there. That is the third stage after recording and classifying phase. Got it? So this is what we are going to do in this chapter. Our first phase is recording. We first are going to learn about recording phase. So my dear students, this is an accounting cycle. This all we are going to learn in this subject. We will learn that when the transaction occurs, the source documents arise. What are the source documents? The documents which tells us that the business transaction has occurred. Say for example, invoice. Invoice tells us that certain transaction has occurred. Say for example, receipt. Receipt is issued by the supplier. It tells us that an amount is received, transaction has occurred. Say for example, quotation. Quotation is issued by the multiple kind of suppliers who wish to sell their products. So quotation also tells us that certain transaction is due to happen. It is a source document. So there are so many source documents which tells us that the transaction has occurred. When transaction occurs, we have to record it. The books in which we do record the transactions are known as books of prime entry, which are 7 in number. Then, when the recording phase ends, we move to the next phase, that is classification of those transactions. The books in which we classify the transactions are known as ledger accounts. When this phase ends, we move to the trial balance. Trial balance is not the part of the double entry system. This is just the memorandum account which we prepare before to summarizing the financial statements. We do see that whether both the sides are balanced or not. If both the sides of a certain account are not balanced, it means that we have made some mistake. That mistake has to be resolved once we move to making of the financial statements. Got it? And this is the last phase in accounting cycle. Our end is going to be on the preparation of the financial statements. We will learn how to prepare the financial statements. Now our first topic which we need to study, students, is it visible? Very less it is. Rounds 1. So source document, students, source documents can be any document giving rise to the transaction. All those documents which tells us that a certain transaction has occurred are known as source documents. Say for example, quotation. What is a quotation? Quotation is issued by suppliers. Say, for example, an ad is given by a company that we require something. Different suppliers are going to give their quotation that we can supply you this product at this price. We can supply you this product at this much quality and quantity at this price and at this date, we can provide you this particular product which is required by you. So when companies do require something, sometimes they do give an ad. A response to that ad can come in the form of a quotation. Different suppliers are going to submit the quotation. Whichever company is going to find the best one, they are going to accept it. So that is a quotation. So quotation is one of the source document. Then purchase order. Purchase order is again one of the source document which is issued for the purpose of purchases. Sales order, it is issued for the purpose of sale. Goods delivered note. Goods delivered note when the goods are going to be dispatched. It is also known as goods dispatched note, GDN. Goods delivered note or goods dispatched note. It is going to be issued by the supplier when the goods are going to be delivered to the receiver. Got it? So it gives rise to the transaction. GRN, goods received note. When the goods are going to be received by the customer, it is going to be issued then. Got it? Invoice. Invoice is issued by the supplier, which is going to record the quantity and the price of the product. The price and the quantity of the product together with the other important information, it is going to be issued. Then statement of accounts. How much is going to be received from the customer? This is a statement of accounts, and especially issued when there are credit transactions happen. When the credit transaction happens, obviously the routine account is opened and the statement of accounts is given in order to tell that this much amount is paid and this much is due. Same is the case with the credit note and debit note, which is not necessary to be discussed right now. You will be confused. Remittance advice and then receipt. All of us do know that what is a receipt. Anyhow, you will not be judged on the meaning of these things in your exam. You must be knowing just that source documents do tell us that the transaction has occurred. When the transaction is going to occur, what we have to do? We have to record them in the books of prime entry. So the first step where recording is going to be started is through books of prime entry. As I have told you that there are 7 books of prime entry, namely sales day book, purchases day book, sales returns day book, purchases returns day book, cash book, petty cash book, and journal. Students, sales day book is to record credit sales. Cash sales are not recorded in sales day book. Purchases day book is for credit purchases. Whatever we are purchasing, we are promising the supplier that we are going to pay you in the future. Only those transactions are going to be recorded in the purchases day book. Sales returns day book. What is sales return? If we have sold something and our debtor is returning the goods to us, maybe because the quality is not as per requirement, or maybe something is lost, or maybe something is cracked, or something is missing. So the goods are going to be returned back. These are sales returns. So sales returns, which are being done on the credit basis, which are for the goods which have been previously sold on credit, will be recorded in this book. Then we have purchases returns day book. Only credit purchases return will be recorded in this book. Cash book, all the cash transactions, whether cash sales or cash purchases are there, will be recorded in the cash book. Petty cash book. This is for the small amount cash transactions. For routine cash transactions and for petty nature cash transactions, this cash book is maintained. And journal. All those transactions which are not recorded elsewhere are going to be recorded in this book of account. Say, for example, depreciation. Say, for example, non-current assets purchased on credit. So these are the transactions, non-routine transactions, which are not recorded elsewhere. My dear students, whenever any transaction has to be recorded, it will be bringing a double effect. And for recording that double effect, one account is debited, which we do denote as DI. We do denote debit as DI. One account is debited and the other is credited, which we do denote as CI. Whenever any transaction is going to happen, it will be bringing at least two effects. One account will be debited, one or more account can be debited, and one or more account is going to be credited. Debit and credit will be having an equal and opposite impact. Say, for example, by debiting two or more accounts, by debiting one or more account, if the total amount is 100, so by crediting one or more account, the effect should be 100 again. That is why it will be making a balance in all the transactions. Got it? It will be bringing an equal impact. One account will be debited and the other will be credited. Whenever any transaction is going to occur, this is the routine which we have to follow. But when we are making these 6 books, these are routine nature books. 1 to 6 are routine nature books. The transactions are happening on the daily basis in them. That is why instead of recording the transaction in this way, for all of them, we do maintain the books in this manner. Every transaction is bringing this impact, but we maintain the first 6 books in this manner. Got it? Sales day book, purchases day book. If you can see, purchases day book, sales and purchases returns day book, cash book and petty cash book. What is happening in the sales day book, students? All the credit sales are recorded in this book. On 4th January 2006, to our customer Jake, we have sold the products for 4,500. On the same date, we have sold the goods to our customer Bella for 3,000. For all the transactions in the same day, for all the credit sales in the same day, we are just writing the names of the customers and we are recording the transactions. Look that all these transactions are happening in the same day. These all transactions are happening in the same day. That's why this account is very busy account. In the organization, purchases and sales is a routine work. It happens again and again. That is why instead of recording the transactions in this messy manner, we do just maintain the sales day book in this manner. And when ultimately the transactions have to be transferred to the ledger, to the classifying stage, then we pass only one accounting entry, that is debit receivables and credit sales with the total amount of transaction. In this case, only when we are transferring the total amount to the ledger, single time we do pass this accounting entry. But when we are passing the transactions in our journal, that is the 7th day book, over there we are going to follow this format for every transaction because those are non-routine transactions will be occurring not on the daily basis. Clear, my dear students? On which basis we do for, pass this transaction, I will be telling you. But before to that, this is must for you to know that why we do maintain the sales day book in this manner, because the agenda behind is that one account has to be debited and the other is credited. It is following the same principle, but the method to maintain it is different because these are busy accounts. For every transaction, again and again, we cannot pass this transaction. Got it? Mariam, are you cleared?
Yes, ma'am.
So only one time, ultimately at the end, we are going to pass this transaction. Clear? Same is going to happen in the case of purchases daybook. All the transactions in one day in multinational companies, there can be thousands or millions of transactions happening in one day. So that is why it's not possible for them to pass the transaction, pass the double entry again and again. So to maintain the books in this manner, and all the persons from whom they are purchasing, they are simply writing their names and the amount of purchases they are writing. They are writing the invoice numbers and they are maintaining the total. Once this is going to be transferred to the ledger at the end of the day, when the classification phase starts, then they pass a single time double entry and they will be transferring. So for purchases, it will be debit purchases account and credit will be payables. Got it, students? Same is the case with the sales. Debit receivables, credit sales. For purchases, purchases account, debit, payables account, credit. On which theory we do pass this transaction? What is the theory behind? We are going to discuss. Same is going to be applied in the case of sales returns daybook. If we have sold something on credit, but our customers are not liking that product and returning those products to us, we are going to record them in sales returns daybook. Purchases daybook, if we have purchased something from our creditors and we are not liking that product and we are returning the things to our supplier, we will be recording them in purchases returns table. Again, you can analyze that the transactions are in the same day. Busy accounts are these. That is why we are going to record them in this manner. Ultimately, when we are going to transfer them to the ledger accounts, we are going to pass the double entry. Now, students, here is illustration number 1, and here we are going to study about recording of the transactions. Okay, before to that, no. Before to that, this one. We will be going towards it, but before to that, we are going to study it. Rules of debit and credit. On the basis of which rules we are going to debit some account, on the basis of which rules we are going to credit the other account. There are 5 elements of accounting: assets, liabilities, equity, income, and expenses. Students, whenever there will be an increase in asset, we are going to debit it. Whenever an asset is increasing in the business, whenever an asset is coming to the business, we are going to debit it. Say, for example, we are purchasing a van. Van is coming in the business, asset is increasing in the business, we are going to debit it. We are going to credit the asset when it is decreasing. Whenever is asset decreasing, we are going to credit it. Say, for example, we have purchased a van and we are giving a cash for that purchase. Cash is also an asset. One asset is increasing, but the other asset is decreasing. We are going to debit when we are going to credit cash, because decrease in asset is credit. Got it? So if I say that the transaction has happened, purchase, delivery van for cash, what is the transaction then? Debit, delivery van, credit, cash. Where are we going to record this transaction? In journal, because this is not a credit purchase. This is not a credit sale. This is not a purchase return. This is not a sales return. This is a cash transaction, but non-routine cash transaction in the journal and in the cash book. Petty cash book, it is not a small amount transaction. So whenever asset is going to increase, we are going to debit. Whenever asset is decreasing, we are going to credit. Say, for example, we have sold something for cash. If we have made sales and we have received cash, which thing is increasing in the business? Which thing is coming to the business? When we are selling something, What am I receiving? What is the business receiving? Cash. Cash is an asset. We are going to debit cash. If we have sold inventory and we are getting cash, credit is going to be the sales. If we are selling our asset and receiving cash, asset is going to be credited. That asset is going to be credited. Why? Because decrease in asset is credit. Say, for example, I'm making a non-routine transaction and I'm selling this camera to Samiha. I'm receiving cash and camera is going out of the business. Cash is debit, camera is credit. If I am dealing into the business of camera and I am selling this camera to Samiha, I am receiving cash, asset is increasing, but now camera is not going to be credited because this is not the asset which I have sold. This is the normal transaction. Sales are going to be credited. Anyhow, liability. When liability is going to increase, we are going to credit. When liability is decreasing, we are going to debit. Again, I repeat, it's just opposite to the asset. When liability is increasing, we are going to credit it. When liability is decreasing, we are going to debit it. Say, for example, if I say that the transaction has occurred, business has received loan in the form of cash. What is a loan? Loan is a liability. So what do we need to do? We need to credit loan. And what are we going to debit? What are we going to debit? Loan received in the form of cash. Which thing is coming in? Which thing is increasing in the business? Cash. Very good. It's an asset. Increase in asset, debit. So dual effect is debit, asset. Asset is increasing. Liability is increasing. Both the things are increasing. Cash, debit, loan, credit. If, say, for example, I say that I have business has, I means business. I have purchased something on, I have purchased the goods on credit. By purchasing the goods on credit, now the responsibility on the business has increased. Am I right? So when the liability increase, something has to be credit. Which thing is going to be credit now? To whom I have to pay in the future? Payables. Payables are going to be credited now. And which thing I am going to debit? Purchases. Okay, anyhow, equity. Equity is going to have the same treatment as liability. When the equity increases, credit. When the equity decreases, debit. Equity, you can consider that the right of owners in the business is equity. The right of the owners in the business is equity. And students, the right of third parties in the business is liability. I held one point over there. Do you remember? In liabilities, they wrote over there that the claim of the third parties in the business is liability. The right of owners in the business is equity, while the right of third parties in the business is liability. We are going to elaborate this point in future as well. Anyhow, the same treatment for equity is going to be when equity is increasing, it's credit. When equity is decreasing, it's debit. Say, for example, investors have invested amount of cash in the business. Equity, capital. Capital introduced by the owner. Capital, equity is the right of the shareholders. Equity increased, it is going to be credited. Equity is going to be credited. What else is going to be debited then? Equity is introduced in which form? Capital is introduced in which form? Transaction is cash introduced as capital in business. Cash introduced as capital in the business. Equity is increasing. We are going to credit equity. Am I right? In which form this is introduced? Cash. Asset is increasing in the business. Cash account debit, equity account credit. Getting, Samiha? Anything you didn't get? No, I didn't get this. This one? I hope you don't mind. I have removed my mask. which thing is coming in the business? Please keep in mind the business entity concept. Which thing is coming in the business?
Yeah.
Cash is coming in the business. Asset has increased. We are going to debit it. Which account we have to credit? Equity. Right of the owner in the business has increased. Increase in equity, credit. We are going to credit equity. Got it?
I'm getting this, but I want to know how increase in equity is credited. I don't know that. Why increase in equity is credited?
Why is it credit? These are the rules of debit and credit. No, you mean to ask that how the right of the owner in the business is increased?
Yeah, that's right.
Okay. Actually, this is the rule that whatever is left over in the business after fulfilling all the obligations is the right of equity shareholders. The cash which they are introducing in the business after fulfilling all the obligations, whatever is left over in the business will be going to the equity holders. Got it? We are further going to discuss the accounting equation as well, is it? That is assets minus liabilities is equal to equity. This is known as an accounting equation. And this is on the base of which accountancy is based, and even financial management is based. This equation tells that whatever is left over in the business after fulfilling liabilities is the right of equity holders. Got it? The cash introduced by them in the business, even the retained earnings in the business, whatever premium the business has received is the right of the equity shareholders. So whenever the capital will be introduced by them, investment is going to be made, their right on the business is going to be increased. Income. Whenever income is going to be increased in the business, any kind of earning is going to be received by the business, whether in the form of the cash or not. Whenever it is going to be becoming a right of the business, it is going to be credited. Increase in income, credit. Decrease in income, debit. Say for example, if interest is received from any investment, the company has given loan to any party and now the interest is received. What is an interest? It's an income. Increase in income will be credited. So we are going to credit interest income. In which form are we receiving that interest?
Cash.
In the form of cash. Asset is increasing, we are going to debit cash. So debit cash, credit interest income. Say for example, if we have received any rental income, if the business has given any property on rent basis, and we are receiving that rent in the form of cash, rent income has increased, income increased, we are going to credit it. In which form are we receiving that particular rent? In the form of cash. We are going to debit cash because cash is an asset. Increase in asset, debit. And the fifth point, expense. Increase in expense, debit. Decrease in expense, credit. Whenever any kind of expense is increasing, we are going to debit it. Whenever any expense is decreasing, we are going to credit it. Say for example, in income we have considered that business has received interest. Now suppose if business has taken a loan and business has to give interest in the form of cash, if the business gives interest, what accounting entry we are going to pass? Interest expense is now going to be debited because increase in expense is debit. Got it? In the form of cash, business is giving this interest. Cash is decreasing. Decrease in asset, credit. The accounting entry will be debit, interest, expense, credit will be cash. Got it, Afa? At this point, it can be difficult for you, I agree, because this is just the starting point, but we are going to do the transactions again and again. So it will be clarified to you. Got it? So now, right now, you need to learn this. If you can see, asset and expenses have the same treatment. Liabilities, equity, and income do have the same treatment. Increase in expense, debit. Decrease in expense, credit. Increase in asset, debit. Decrease in asset, credit. Increase in liability, equity, and income is credit. Decrease in liability, income, and What is the third one? Equity, credit. Got it? Debit, sorry. So this is how we are going to learn the rules of debit and credit, and this is the base. I hope you are clarified up till now. My online students, how are you?
Ma'am, it's a bit confusing.
You are going to be confused here. You will be confused. I can expect a confusion from. How are you, Samiha? Now Samiha's hand is on. Thank you. It will be becoming very easy for you, and one day you will literally going to enjoy debit and credit.
You'll explain debit and credit in a bit detail. It will become easy.
In a little bit more detail?
Yeah, only debit and credit. What is debit and what is credit?
Okay. In double entry system, we have to record the transactions with the help of debit and credit. One or more account has to be debited, and one and more account or more account has to be credited. Whenever any transaction happens, one effect has to be debited and the other effect has to be credited. Debit and credit will be bringing on equal and opposite effects. Got it? Whenever any transaction is going to happen, it will be bringing on dual effects. One will be debit and the other will be credit. We do denote debit as DR. We do denote credit as CR. Got it? And 5 elements of financial accounting are there. We do need to learn that whatever is going to happen in these 5 elements of the financial accounting, what is going to be the effect? Got it? If asset is increasing in the business, we are going to debit it. If asset is decreasing in the business, it is going out of the business, we are going to credit it. Asset coming in, debit. Asset going out, credit. Got it? On the other hand, liability. When liability is increasing in the business, business is becoming liable to do something, it is going to be credited. When the liability is released, when the business has paid that liability, it is decreased, we are going to debit it. Equity. When cash is introduced in the form of capital in the business, cash is coming in the business, equity, the right of the owners in the business has increased, we are going to credit it. When equity is returned, it is going out of the business, we are going to debit it. On the other hand, income. Whenever the business is earning any kind of income, whether through the ordinary course of the business or from the other sources, whenever income is earned, we are going to credit it. Whenever income is going to be decreased, it is credit, it is debit. Got it? Last one, expense. When the expense is going to be increased, it is going to be incurred actually. We are going to debit it. Whenever expense is going to be reduced, we are going to credit it. Got it? Okay, now my dear students, let me just extend it. Okay, now one more confusing point is there. Now I can expect that at every point you can be a little bit confused, okay? But this confusion is actually required right now. Whenever we are purchasing an asset is purchased, we are paying something for it. Am I right? Whenever we are making an expense, we are bearing something. Cash outflow is happening, or we are making the economic resources to go out from the business. In both the cases, something is going out from the business. Then how can we say that something is an asset and something is an expense?
We use the advantages of asset in our business.
Okay, and for expense, we are not going to use the advantage?
Expense is something we have already discussed.
We have discussed it?
Yeah, expense is something whose benefit we have already taken.
Yes, that's correct. Yes, in transactions, you can be confused that how we can differentiate among asset or an expense. We need to consider that if the benefit is expired, that is an expense. If the benefit is not yet expired, the particular thing is an asset. Say, for example, if I am bringing the seat to the college, this is an asset. because the advantage from this seat is yet to be taken. If say, for example, I'm bringing this camera, this is again an asset because the advantage from this is yet to be taken. On the other hand, if say, for example, I'm paying an electricity bill for all this month at the month end, that is an expense because the benefit is already taken. Got it? In both the situations, the cash may be outflowed, but you need to differentiate with the help of this concept that whether the benefit is expired or not. Very good, so that you remember this concept. Now, Samiha, is it cleared? Afaq, cleared? Did you remember this concept? That's great, great. Yes, Aisha, Rabia.
Yes, ma'am.
Are you clear, dear?
Yes, ma'am.
Okay. Look, every business transaction requires corresponding entry to a different account. This is double entry system. Corresponding accounts, debit and credit. Opposite and equal effects. Now, students, from here we are going to start practice. This is the first illustration with the help of which we are going to do the practice of debit and credit.
There was some slides related.
Sorry?
There were some slides.
Yes, previously. That is again for the practice, we are going to move to them again. Okay? Actually, I have placed them in the wrong place. They should be coming after them. Okay, the transactions. Here are the transactions. There are 5 days in which the transactions have occurred, and you are required to pass the double entry for this. My online students, which thing is fine for you? Shall I write over here on the left side of the board or on the right side? Which
Left
side is fine? Here?
Ma'am, left side. Yes.
Oh, great. Day 1. They say the transactions of the new business in its first 5 days are as follows. And we have to record the double entries for them. The first one, Yvonne commenced business introducing 1,000 cash. Yvonne is an owner. He has commenced business introducing 1,000 cash. Which thing is coming in the business?
Asset.
Which thing? It's asset or not, but which thing is coming, which thing is increasing in the business? Cash. And cash is asset. Increase in asset is debit. Increase in asset is debit. So for this, what we are going to do? Debit will be debit, DR. Debit will be cash account. Students, the short form of cash is AC. Got it?
Ma'am?
Yeah. Yes, dear.
Can you?
Yes, dear, please. Mariam, you need to. Yes, who was speaking?
Ma'am, you are writing on the board now. We can't see there.
You can't see?
Yes. Can you write with the same line, day 3? Now we can see.
Is it fine now? Okay. Debit will be cash account. What is the amount? $1,000. What is going to be the opposite impact now? Cash is increasing. We have debited it. Which account are we going to credit? There will be something to be credited also. Which other thing is increasing or decreasing? Yes, Hiza?
Asset.
Asset is decreasing? Which asset? Asset is increasing, cash is increasing. We have debited it. Which other thing is increasing or decreasing? When the capital is introduced in the business, equity increases. The right of the owner in the business increases. Equity increases, we have to credit it. Increase in equity, credit. So what are we going to do? We are going to credit equity account. But over here, capital, because in sole tradership and partnership, it is capital account. In limited liability companies, it's equity. Over here, because only one owner is mentioned, we are going to credit capital account. Got it? How much amount? 1,000. It's balanced. Cleared? Normally, we do give a narration also below to this transaction. The small statement showing that what has happened in the transaction. Cash introduced in the business. Got it? But because you will be dealing with the multiple choice questions, it's okay. Up to you. They do bought a motor car for $400 cash. Now a motor car has been bought for cash. Cash is being given in order to purchase a motor car. Which thing are we going to debit? Which thing are we going to credit? Students, are you able to see my online students?
Yes, ma'am, you can write.
Okay. Bought a motor car for $400 cash. They are not able to see, I feel. Is it? Anyhow, I don't know. Bought a motor car for 400 cash. Which thing is increasing in the business?
In the top.
I'm writing at the top. You are not able to see?
That's why we are seeing the board, but because you're writing in the top, so screen is not capturing.
Are you able to see now?
Yes, ma'am.
Okay, bought a motor car for $400 cash. Which thing is increasing in the business? Which thing is coming in the business? Motor car. Motor car is an asset, tangible, non-current asset. Increase in asset, debit. So what are we going to debit? Motor car account. How much amount is it, students? 400. Another account has to be credited. Which other thing is increasing or decreasing in the business? Bought a motor car for cash. Cash is going out of the business. Cash is decreasing in the business. Cash is an asset. Decrease in asset is credit. So credit will be cash account. Students, if at any point you do not understand anything, please ask me immediately. My online students, you especially, because I'm really worried. Mariam, when are you going to join back?
Ma'am, next week, inshallah.
Inshallah, inshallah. So wherever you are not understanding anything, please do ask me immediately.
Ma'am, I didn't get you. It's really confusing.
Actually, you need to attend the classes physically, my dear. This is my fair suggestion. Both the transactions you have not understood, my dear, I just suggest you to go through the rules of debit and credit again. And consider that which thing is increasing and which thing is decreasing in our business. In the first transaction, they say Avon commenced business introducing 1,000 cash. So Mariam, which thing is coming or increasing in the business? Avon commenced business introducing $1,000 cash. Which thing is increasing in the business?
Asset.
Which asset?
Current asset.
Cash. Cash has increased in the business. Am I right?
Yes.
So that is why increase in asset is debit. We have debited it. Can you see? Mariam, can you see?
Ma'am, I can see the board, but we can't see the one you write.
Students, any suggestion? What shall I do?
Ma'am, you can start writing from there. Now we can.
Oh, it's fine. Thank you so much. Thank you. Yes. So, Mariam, are you able to see? Thank you so much, Izar. Thank you.
Yes, ma'am. Now we can see.
Okay, that's great. That's great. So now, which thing is increasing in the business? Cash asset is increasing. That is why we have debited it. Increase in asset, debit. So we have to make any other account credit. Every transaction will be bringing dual impact. Cash is debited. Which other account is going to be credited? Which other thing has increased or decreased in the business?
The capital, we need to credit it.
Very good. Because whenever the cash is going to be introduced as a capital, the equity, the owner's right in the business is going to be increased. So on one side, we are debiting cash as an increase in asset. On the other side, we are crediting capital. As per the rules of debit and credit, increase in equity is credit. Got it?
Yes,
Mariam,
ma'am.
got it now? Okay,
Yes.
good. In the second transaction, bought a motor car for $400 cash. A motor car has been bought and cash is paid for that. Which thing is increasing in the business? Mariam? You need to keep business entity concept in your mind. Business has bought a motor car for 400 cash. Mariam, are you there?
Yes, ma'am.
So which thing is increasing in the business? Mariam, which thing is increasing in the business? Business has bought a motor car. So which thing is coming in the business? Which thing is increasing in the business?
Asset.
Asset, that is motor car. Motor car is an asset. Increase in asset is debit. So we are going to debit motor car account. We have to give a credit to some other account. So which other thing is increasing or decreasing in the business? Cash. We have paid cash to purchase a motor car. Cash is an asset. Decrease in asset is credit. Got it, Mariam? Aisha, Rabia,
Yes.
please update me if you have got the point or not.
Okay, ma'am.
Okay. On day 3, a loan has been obtained. Obtained a $1,000 loan. Loan is a liability. Loan is a liability. Increase in liability is credit. Very good. So we are going to credit loan account. How much loan is there? $1,000. What other thing we need to debit or credit, students? Very good. Which other thing is increasing or decreasing in the business, Mariam? We have credited loan because liability is increasing. Which other thing we need to debit or credit? In which form we usually receive a loan?
Cash.
Cash. Cash is an asset. Increase in
Yes.
asset is debit. So we are going to debit cash account. How much amount? 1,000.
1,000.
Clear, Mariam?
Yes, ma'am.
Now, students, day 4. Purchased goods for $300 cash. Good is a term which is used for all those items which are purchased for the purpose of resale. These are current assets. And whenever the goods are purchased, we do write the name of purchases with them. Got it? When we are going to pass a transaction, we are going to write purchases. Purchase is the term used when the goods are purchased or sold. So purchased goods for 300 cash. Which thing is increasing in the business? Asset is increasing? Yes, you are right. You are right. Inventory is increasing. Which asset is increasing? Inventory. Inventory is increasing. But with which name are we going to write it? Purchases. Debit is going to be purchases. Got it, students? And my dear students, you need to keep in mind that whenever the asset which is purchased not for the purpose of resale is going to be bought, we are going to debit it with its name. Whenever we are purchasing for the purpose of resale in the ordinary course of the business, we are going to write it with the name of purchases. And purchases are debited because expense has increased in the business. The theory behind it is not that the asset has increased. The theory behind it is an expense has increased. Do not confuse yourself, because even if you are going to keep it in your mind as an asset also, it's fine. But whenever in some books, if you are going to find, when they tell you about the rules of debit and credit, with expense, they mention purchases also. Whenever the purchases increase, debit, purchases decrease in the form of, say, credit. Got it? So you need to keep in mind also, okay? Okay, now, so we have debited purchases. Which other thing is going to be debited or credited? Now Rabia is going to tell me. We have to credit some other account. Is it, Rabia? You don't hesitate. Whatever comes to your mind, please tell. Discuss it.
Can you, ma'am, ask again?
Sure, dear. We have purchased, so we have debited purchases. Which other account are we going to debit or credit? Which other thing is increasing or decreasing?
Cash. Debit.
Cash is increasing?
Increasing, ma'am, maybe.
Cash is increasing?
Yes.
We have purchased goods and we have paid cash. So cash is?
Decreasing.
Decreasing.
Yeah, sure.
Whenever the cash decreases, asset decreases, we have to credit it. What is the amount?
Ma'am?
Yes, dear.
Can you take a picture of this and send in group?
Sure. I will be sending. But my poor handwriting. Okay. I think you can read it. Anyhow, day 5. Sold all the goods purchased on day 4 for $400 on credit. Now, my dear students, you need to think. The goods have been purchased for $300 and they have been sold for $400. $100 is profit in it. Am I right? $100 is profit in it. So what accounting transaction you are going to pass over here? What are you going to debit? What are you going to credit? Sold all the goods purchased on day 4 for $400 on credit. Which thing is increasing in the business? Sorry? Income is increasing in the business? Okay, I agree to that. We are going to credit income. Which income is increasing? Sales income. Sold all the goods purchased on day 4 for $400 on credit. Income is increasing. Sales. Whenever we have sold the goods in an ordinary course of the business, the term which we are going to use is sales. If we are selling a non-current asset, we are going to credit with its name. But if we are selling the goods purchased for the resale purpose, we are going to give them a name of sales. This is sales income. This is purchases expense. Got it? Sales income has increased. How much income has increased? How much income has increased? 100?
400.
No, but we are receiving all of the money. We are going to receive all of the money. It's all from the sales. Am I right? 400? Okay. First, tell me what are we going to debit over here? Purchases? We have not purchased anything. So we are not going to debit purchases. They are not. Samiha, they are selling that sold all the goods purchased on day 4. We have sold the goods. So purchases are not made. So we are not going to debit purchases.
Debit cash.
We are not selling for cash on credit. We are yet to receive cash. Cash is not received. Right to receive cash is maintained. Got it? Right to receive cash is arising. It's on credit. We have sold something and our debtor, our receivable has promised us to pay in the future. So the right to receive in future is arised. When right to receive in the future arises, it's asset. It's asset. Asset is any economic resource which gives rise to the economic benefits. Which asset has arisen? Receivables. Do you remember receivables are current assets? How much we have to receive from our receivables? $400. How much amount goods we have sold? 300. 100 is still missing. What is that 100? Very good. Profit. Credit is going to be one more account that is profitable. How much profit? 100. So now, on the opposite side, more than one account is credited. This is double entry system. Every transaction will be bringing 2 or more than 2 effects. But the same debit and credit is going to arise. Credit is 400, debit is 400. Got it? You have come to know one more point, that profit is always credit. Loss is debit. Loss is debit, profit is credit. Now have a look at this problem once again. For my online students, I'm just sharing it in the group. I'm really sorry for my writing, but even if I try, I cannot improve. With the passage of time, it has become worse. So students, I have shared it in the group, okay? You may not find it in the book because in the book, they have done this example illustration from the perspective of accounting equation. That is another thing. But because I was not finding a lot of data in your book, that is why I've taken this transaction, this particular example to do it for accounting entries. Okay? Have a look at this once again. Time of the class is over. Have a look at this once again, and I will be giving you homework as well. Students, I will be sending you these presentation slides, and your homework is okay, I will be sending you your homework separately. In the WhatsApp group, I will be sending it to you. Okay? And in our next lecture, then we are going to start by passing the accounting entries. 3 to 4 examples we are going to do for that. And then we will be moving to the accounting equation. Got it? So this is all for today. If anyone is having any confusion, please do ask me. students, the papers which I have shared with you, the document which I have shared in the WhatsApp group also, today I will be sending it to you on your registered email IDs as well. Please keep it safe with you because in the final exams also it is going to help you. It is having multi-accounting entries in it. Okay, so read them. You will come to know that if some transaction is happening, what is going to be the effect for that. Try to memorize them, try to see that how this effect is coming. Which thing is increasing or decreasing in the business. Okay, and one day you will start enjoying it and you will not be, you will not be required to learn the accounting entries anymore. You will be making your accounting entries by yourself. Okay, so this is all for today, students. I will be sending you the homework in the WhatsApp. And for F1, we are going to have a quiz on Sunday. Got it? So now, Mariam, Rabia, Aisha, if you have any questions, please ask. No questions?
No, ma'am.
I can understand. Mariam, what about you?
Ma'am, can you please tell me about the day 5th?
Sure. On day 5, sold all the goods purchased on day 4 for 400 on credit. Mariam, the goods have been sold on credit basis. Means that goods have been sold, but the amount is not yet received in the form of cash. But the amount is promised to be received in the future. This is a credit transaction, credit sales. The goods have been sold, but the amount is not yet received. In that case, a receivable has increased in the business. A person who has to pay the business is increased. And that person is an asset for a business because this person will be giving rise to the economic benefits in the future. Got it? So that is why we are going to debit receivables. How much amount do we have to receive from them? $400. Clear up to here, Mariam?
Yes, ma'am.
And we have sold the goods. That is why income is increased in the business. Whenever income increases, we credit it. That is why we have credited sales. The amount of sales was 300. The goods which have been sold are for 300. That is why we are giving the credit to sales for $300. And remaining 100 is profit made. Because the goods were costing 300, we are selling them for 400. So remaining 100 is profit for us. So we are crediting profit also.
Okay, ma'am. Thank you.
You are welcome, dear. Okay, students, then this is all for today. See you next week.